Hello, this is another basic guide to tax for you. This time we're going to look at inheritance tax. And inheritance tax is basically a death duty. So it's mainly a charge to tax on death. There has been death duties in the UK since 1800 and something, I think, varying across different types. And ultimately we've got inheritance tax now. So it basically is meant to be a tax on the value of somebody's estate when they die, which is really their assets less their liabilities. But it does catch some transfers which are made during lifetimes, and that's basically a policy reason really to prevent people avoiding a tax on everything that they own on death by reducing the size of their estate by making gifts during their lifetime. Okay, so what is inheritance tax payable on then? So I've just put a nice little picture of a kitten here because I thought it might relax you, because I know most of you don't really like tax. So I just thought, let's have a little kitten. That makes us all feel better. But anyway, as I said, inheritance tax, the primary time when you'll come across inheritance tax is on death. And obviously everybody dies, although not everyone will be charged inheritance tax, because obviously if you don't actually have any assets on death you wouldn't be charged, but also any gifts which are made within 7 years of death can be charged to inheritance tax, and that's gifts made to individuals within 7 years of the death of the donor of the gift, and also there are some lifetime chargeable transfers immediately chargeable to tax, which are basically gifts to a company or into a trust. And the gifts made within 7 years of death, the potentially exempt transfers, may become chargeable if somebody then dies within 7 years, whereas those lifetime chargeable transfers made to a company or made to a trust will be immediately chargeable to inheritance tax. Okay? And for inheritance tax, there's basically just a 4-stage process that you have to go through. So you have to identify the transfer of value, find the value transferred, apply any relevant exemptions or reliefs, and then calculate tax at the appropriate rate. So it doesn't sound too difficult, and if you just split it up into these 4 steps each time, then hopefully it'll be manageable. Because remember, in the SQE1 you're doing multiple choice questions, so you aren't going to be given a huge inheritance tax calculation with lots of potentially exempt transfers, lifetime transfers and a charge on death, because you're not going to be able to do that in anything approaching 1.4 minutes. So you're only going to be asked to do individual little parts of this. But like with income tax, sometimes sort of seeing the whole of it can actually help you to hang those individual little parts on. So inheritance tax is charged on the value transferred by a chargeable transfer. So what do we actually mean by that? So identifying the transfer of value, that's basically any disposition which reduces the value of the transferor's estate. And during the lifetime, that would be if they usually make a gift, because that's a time when you are reducing the value of your assets. You know, if I gave away £100,000 tomorrow, then at the end of tomorrow, I am worth £100,000 less than I was at the start of the day. Whereas if I sell an asset for £100,000, then actually I'm still worth the same amount of money, aren't I? Because I've just swapped how my money's held. I might have had an asset worth £100,000, but now I've got actual money for £100,000. I'm still worth the same amount. If I give that away, then I'm worth less than I was before. And on death, the deceased is treated as having made a transfer of value basically of the whole of his estate immediately before he died. Okay, so there's got to be this transfer of value. It doesn't count, you know, if you make a bad bargain or something like that, that's not a transfer of value. Okay, the value of your estate has gone down, because if I sell an asset that's worth, you know, £100,000 and only sell it for £90,000, then I am worth less at that point. But that wouldn't be caught to inheritance tax. You know, you didn't intend to do it, you weren't intending to make that gift, that sort of thing. So you're really looking for, is there a gift? Is there something going without any consideration coming the other way? And then finding the value transferred, that's basically looking at the reduction in the value of the estate. So what was it worth before the gift compared to what is it actually worth now? And as I said, on death, it's really the value of the estate. There are then various exemptions and reliefs that you can use, and they're all there for policy reasons, really. And they can reduce or eliminate the value transferred, or reduce the amount of tax that's actually going to be paid. Some of those exemptions and reliefs are only available on death, so that's really the nil rate residence exemption there, and some of them are only available on lifetime gifts, so you've just got to learn which ones are applicable to which particular type when it actually occurs. And then finally, you calculate the tax at the appropriate rate. So the first amount of tax is at 0%, and that's in what's called the nil rate band, which is currently £325,000. You might also have a residence nil rate band available on death, and we'll look at the conditions for that in a moment. If you die whilst holding a qualifying residential interest, and there could be other things, other exemptions that have reduced the amount of your estate, obviously. But when you're looking at that £325,000, it's the first gifts that actually get access to that £325,000. So think about it, you know, remember when we were looking at income tax, when, you know, you had those different bands of tax, and it was the first one that got the basic rate band. So with income tax, remember, it was their non-savings, non-dividend income that had the sort of first bite at that basic rate band, and then you dealt with the savings and the dividend income afterwards. So this is a similar thing. The first gift in time that you're looking to tax will get that £325,000, and then once the nil rate band has been used up, then you're going to have to be charging tax, usually at 40%, but there is also 20 and 36% rates as well, and we'll look at those in a moment. Okay, so that's the approach to take for each of these gifts that you're looking at, whether it's individual gifts that have been made during lifetime, or whether it's the sort of whole thing really on death. It's identify the transfer value, find the value transferred, apply any relevant exemptions or reliefs, and then finally calculate the tax that's due at whatever rate is going to be relevant. Now I'm just going to take it in a slightly different order than it looks at in the study guide, because I want to start off by looking at the situation on death, because, as I said at the beginning, that is the most common situation when you're going to be paying inheritance tax, is on death. So let's deal with that first, and then we'll come back and look at lifetime gifts in a moment. So as I said, you've got to identify the transfer of value, and it's treated as though that individual made a transfer of basically all of their sort of assets immediately before death. And you're looking at the assets that they were beneficially entitled to. So that includes everything that would have gone under their will or intestacy, because that's property that they are beneficially entitled to, that, you know, they own that property. But it also includes other properties. So other property that they're beneficially entitled to, the most common of that would be anything that they own as a joint tenant with somebody else, because obviously that wouldn't pass under their will or intestacy, because the whole point about joint tenancy is survivorship. But that still counts as assets which are within the death estate. Okay, and usually with a joint tenancy, it's 50% of you own 50% of the asset. Also, there are some things which are part of the estate because of statute, and they're usually policy reasons, and it's again to try and stop you avoiding inheritance tax on death. So certain trust property would be charged to inheritance tax, and in particular things things which are called gifts with a reservation of benefit. So that's to try and stop you giving away something but actually really holding on to it. So if I say, oh, I'm going to give my house to my son, for example, but actually I'm going to carry on living on it as though it's exactly my house, then actually I haven't really given it away at all, have I? I've just pretended to give it away, while really I'm still living in it. So that's a gift with a reservation of benefit that would actually count as part of my sort of death estate in that situation. So you're considering, you know, what assets the individual was beneficially entitled to immediately before death. So some common things which don't come within that perhaps are things like sort of if you have a life insurance policy, but if it has been written into trust, so there's a beneficiary that's going to get that life policy, then that doesn't form part of the estate because it doesn't come into the estate. Instead, it's paid directly to that beneficiary. So that wouldn't count. And another one would be the sort of discretionary lump sum sometimes that you get from a pension fund, because again, the pension fund trustees have a discretion about who to pay it to. They're not automatically going to pay it into the estate. They, you know, could pay it to house or a child or something like that. So that's not part of something which the individual is beneficially entitled to. Okay, then finding the value transferred, the next stage. Assets are generally valued at the price that they might reasonably be expected to fetch if sold in the open market. So it's generally an open market valuation. Sometimes it can be much more complicated than that, particularly with things like shares, when the percentage that you own might affect the value of the shares. Obviously in business you've looked at, you know, if you have more than 25% of the shares, or if you've got 50% or over 50% or 75% of the shares, having that particular power base being able to block or pass resolutions means that each individual share that you own might be worth more for you than somebody who's got a more minority shareholding or something like that. So in those situations, there might be some negotiation between the PRs and HMRC to actually agree what the price is. And once they've actually done that and agreed what the valuation is, then that's what's often referred to as the probate value of that particular asset. You can also take off any debts and expenses of the individual. So, you know, if they had outstanding bills, you know, if there was a mortgage on the property, even their funeral expenses would count as a debt and a liability for those purposes. So you can reduce that to actually end up with the sort of net value of the estate to get the value transferred. Next thing is to apply any relevant exemptions or reliefs. So the first one to look at is the spouse or civil partner, and any assets which are going to the spouse or the civil partner are completely exempt from inheritance tax. There'll be no charge to inheritance tax if you're leaving assets to your spouse or your civil partner, but not just to a cohabitee. So you've actually got to have formalised that relationship either by marriage or by entering into a civil partnership. The charity exemption is that any gift that you make to charity will not be charged to inheritance tax. And if you make a big enough charitable gift, so basically if you're giving away 10% of your net estate, that will also reduce the amount of tax that the rest of the estate would actually have to pay. But it's relatively rare that people tend to give away that amount of money to end up benefiting from the charity exemption, because usually people might give small amounts to charity, but not 10% of their estate. Or they go the other way around, that they actually give the bulk of their estate to charity, and then any personal gifts that they give to people tend to be within the nil rate band. So it's relatively rare that people use the huge amount of charity exemption, in particular to get the rate of tax down on the rest of the estate. Business property relief, which I think now is actually called business relief, and they've dropped the property, but it's a bit easy to remember it as business property relief. To qualify for that, the deceased or the transferor has got to have owned those assets for 2 years prior to the transfer, and it relates to either an interest in a business, so a sole trading business or a partnership or something like that, or unquoted shares. They qualify for 100% of relief, and then you get 50% relief if you owned quoted shares which gave you control. So again, relatively rare to have a quoted company where an individual has control of it. And also you could get 50% relief where certain assets have been retained by the owner of the business themselves, but have been used in the business or the partnership for business purposes. So that's how business property relief applies. And agricultural property relief works in very similar ways. Okay, so it's basically the same thing, owned it for 2 years and so on. Okay, so you take off any of those relevant exemptions or reliefs, okay, and then the next stage is to calculate the tax at the appropriate rate. So the first thing is the nil rate band, which is £325,000 at the moment. It has been £325,000 for a while, but do read the question carefully, because if they're talking about something which has happened in the past, they might give you the nil rate band. So if it's not 325,000 because they're giving an old figure, then make sure you use the figure that it actually gives you in the question. But remember I said that the nil rate band goes to the earliest gift in time. So if there was a lifetime gift within the previous 7 years of death that has used up that nil rate band, then you can only use anything that's left. So say you'd made a lifetime transfer 5 years before you died, then that lifetime transfer would use up the first part of that £325,000, and it would only be if there was anything left that you would then be able to use it on death. So if you'd made a chargeable transfer of £350,000 in the previous 7 years, there would be no nil rate band left. If you'd made a chargeable transfer of 25,000, then there would be 300,000 of the nil rate band left. So you've just got to look to see whether anything has already used it up prior to death. The other thing to remember about the nil rate band is that if the deceased had a spouse or some partner who previously died, so if they're a surviving, if they're a widow or widower, then if on the death of their spouse, that spouse did not use up their own nil rate band, then the person who has now died can increase their nil rate band by whatever percentage wasn't used of the spouse's nil rate band. And you work out how much of the spouse's nil rate band was used. So was there 50% of it left? Was there 100% of it left? Whatever it was. And then you apply that percentage to increase the current nil rate band. So you're always going to be increasing the 325,000, even if when the spouse died in the past, maybe the nil rate band was only £250,000 or something. If they only used 125,000 of it, so it was 50% of it left, you would actually increase the 325,000 by another 50%. So you look at what percentage was unused and then apply that percentage to the current nil rate band to increase it for that surviving spouse who's now died. Then The rate of tax for anything which is outside that nil rate band will be 40%, unless that thing I was talking about with the charity exemption, if at least 10% of the sort of estate that's charged tax, the net estate is left to charity, that reduces the tax that's going to be charged on the rest of it, because obviously the charity bit would be exempt anyway, but it would reduce the tax charged on the rest of it to 36% rather than 40%. And then also you've got to consider whether or not there's any net residence nil rate band available as well. And the residence nil rate band is in addition to that £325,000 nil rate band. And for that to apply, the deceased has to die owning a qualifying residential interest, which is closely inherited. So what do we mean by that? A qualifying residential interest is a house, a dwelling house, which has been the house of the deceased. Okay, so has been where they've actually lived. Okay, and forms part of their estate. And it's got to be closely inherited, which means it's got to be inherited by a child or grandchild or other linear descendant of you. And that includes still children, stepchildren, adopted children, foster children, anyone that you've been appointed as a guardian of. So it's quite a wide set of sort of issues that would count. Or it's got to be inherited by the spouse or the current spouse or the civil partner, or the widow of the current spouse or civil partner, or the lineal descendant who's sort of predeceased. So that can cover sort of remarriages and that type of thing. And the nil rate band only applies up to the value of the deceased residence. So you can't claim for more than the property's worth. But basically that increases the nil rate band that's then available to you. If the estate is valued at £2 million or more, then the residence nil rate band is reduced by £1 for every £2 over that £2 million threshold. So in the same way as the personal allowance was reduced once you got over £150,000 for income tax. So that's how you deal with the estate on death. And as I said, I wanted to deal with that first because that's the more common situation that you might have to look at. But then if we just go back and consider about lifetime transfers and how they operate. So lifetime transfers come in these two forms, the potentially exempt transfer and the lifetime chargeable transfer. So the potentially exempt transfer is a gift made by one individual to another, and it's potentially exempt, so there's no tax paid at the time it is made. And if the giver of that gift, if the donor survives for 7 years after they've made the gift, then there will be no tax to pay. And to work out the tax, if it becomes taxable, you do exactly that same 4-step process that I talked about before. So you identify the transfer of value, so the reduction in the estate that's been made by that gift, and the value transferred. So again, usually the market rate, how much your estate has gone down by making that gift, and then you apply any relevant exemptions or reliefs. And those are the same as on death, apart from obviously you can't use the residence nil rate band, that's only available on death. But you can have the other ones, so you can have the spouse exemption, you can have business property relief, you can have agricultural property relief. The only additional requirements for those, it's the same criteria that the donor or owned them for 2 years before the death, and that you've got the 100% for the partnership or sole trading business, and then 50% for quota or shares, 100% for shares in a private company, but then 50% for shares in a quota company if you have control or for assets that have been used by the business. But the additional requirement on a lifetime gift is that the asset is still owned by the recipient on the donor's death or a replacement asset has been bought. So as well as the donor owning it for 2 years before the gift was made, the recipient has to still own those shares or that business asset or whatever it is on death. Okay, but there are also some additional exemptions, reliefs, which are available on lifetime gifts. So the first one is an annual exemption of £3,000, and if you don't use your annual exemption 1 year, it can be carried forward into the next year. So when you make a gift in a year, you've got to look, was a gift made the previous year? If not, you could increase the annual exemption from £3,000 to £6,000. There's also a small gift allowance, so any gift of £250 or less wouldn't be caught. And another one, which is normal expenditure out of income. So that's usually sort of payments to children, you know, particularly if you're, say, paying money to your child who's at university. So if you're paying their rent every month or something like that, that would be normal expenditure out of income. And also gifts in consideration of marriage, and there's different amounts that you can give depending on the closeness of your relationship. So £1,000 generally, but then if you're a grandparent, then you can give 2,500, and if you're a parent, you can give £5,000 to somebody as a gift on marriage, and that wouldn't be charged to inheritance tax. And as I said, that fourth bit, calculate the tax due, you don't do that when the gift is made, because there's no tax payable when the gift is made. And in fact, if that person survives for another 7 years, then there would be no tax payable at all. With a lifetime chargeable transfer, that's when you make a gift into a trust or a company. Again, exactly the same approach that you take, that 4-stage approach: identify the transfer value, find the value transferred, apply the relevant exemptions or reliefs. The same ones available for a lifetime chargeable transfer as for a potentially exempt transfer, apart from the small gifts exemption isn't available. And then you calculate tax at the appropriate rate. One other thing I suppose I should say for the annual exemption is you only get one annual exemption in a year, so you can't get the first £3,000 of every gift you make. It's only one £3,000 that you would get, or potentially 6,000 if you hadn't made a gift the previous year. And then the tax, you do pay tax when a lifetime chargeable transfer is made. And the first £325,000 nil rate band would be at 0% if nothing has used up that nil rate band within the previous 7 years, and then 20% on the balance. So anything over that £325,000 would be payable at 20%. So unless you've made any lifetime chargeable transfers within the last 7 years, if you've made a pet within the last 7 years, that wouldn't have used up the nil rate band, would it? Because you haven't charged it to tax yet. So it would only be if there'd been a lifetime chargeable transfer in the previous 7 years that nil rate band would have been eaten up. If there was no lifetime chargeable transfer, that £325,000 would be available. Okay, now that's how those operate when they're actually made. But then when somebody dies, you've got to go back to look at what happened to see whether or not that you have to now make any extra payments of tax in relation to any pets which were made within 7 years of death, or any lifetime chargeable transfers that were made within 7 years of death. So what you have to do there is consider what happened within the previous 7 years. So if there are any pets which were made within the 7 years before death, they're now going to be chargeable. They weren't when they were made, but if that donor hasn't survived for 7 years and has now died, then that pet is now chargeable. It was a potentially exempt transfer. It's not exempt anymore because you didn't make it for 7 years. It's now chargeable. So you have to come back. You've already worked out those 3 extra stages that I said before: identifying the transfer of value, find the value transferred, and apply the relevant exemptions or reliefs. But now you've got to come back to that stage 4 and actually calculate the tax at the appropriate rate. And here we've now got to look to see what's called the cumulative total, which is again just looking to see, has anybody already eaten up that £325,000? So you've got to look back. So first of all, you start with death. You look back for 7 years. Was any gift made within that 7 years? And then for each of those gifts that were made within 7 years, you then got to look back another 7 years to see whether or not any lifetime chargeable transfer was made within that 7 years, or whether or not any other pet was made, which is now going to be chargeable. So basically, you start with the date of death and then you immediately go back 7 years and then start working back towards death. So if you died in 2021, you would go back 7 years. So I'm trying to do that in my head now. That's going to be what, 2014, and take the earliest gift. So was there a gift made in 2014? Deal with that one first. Then if there was another gift made, say in 2016, then you deal with that. So you work from the earliest time back towards the death, looking at that cumulative total to see whether or not that £325,000 nil rate band has been eaten up by anything else. If there is any nil rate band available, then you're going to charge tax at 0%. After that, it'll be 40%. But if somebody survives for 3 years after the gift has been made, then taper relief is available. So what you do is you work out how much tax will be payable on that pet, and then you taper the tax. So you don't taper the value of the gift, you taper the tax. So work out what the tax is and then taper that. So if somebody survives for 3 to 4 years after a gift, you pay 80% of the tax, 4 to 5 years, 60% of the tax, 5 to 6 years, 40% of the tax, and 6 to 7 years, 20% of the tax. And then the same approach for a lifetime chargeable transfer. Here you've got to recalculate it. You already paid inheritance tax when they made the gift, but you've got to recalculate it now because, first of all, it could be that the nil rate band, you might have used it when you calculated the tax due on that lifetime chargeable transfer at the time it was made, but something might now have jumped in and eaten up that nil rate band because, of course, that any pet that was made before that lifetime chargeable transfer wouldn't have used the nil rate band because it wasn't chargeable. But now if that pet has become chargeable, but it was earlier than the lifetime chargeable transfer, it will get first bite at that nil rate band. So it might be that you're having to pay more tax because you worked it out on the nil rate band that's no longer available, and also because tax on lifetime chargeable transfers is at 40% if the nil rate band isn't available, compared to 20% when you actually made it. So again, you work out that cumulative total. You look at, were there any lifetime chargeable transfers made up to 7 years before that lifetime chargeable transfer that have eaten up the nil rate band? Were there any other pets made which are now going to be chargeable? And then, is there any nil rate band at 0%? If not, it's going to be at 40%. Taper relief again available. And then once you've worked out what tax is overall charged on that lifetime chargeable transfer, you credit any tax which has already been paid. So when you paid that tax at 20% when the gift was made, you don't have to pay that again. You can reduce the tax due by the amount that's already been paid, but only down to 0. You don't get a refund of anything which has actually been paid. So that cumulative total is probably the most complicated thing that you have to think about. So what you need to do is you need to start with death and then look back 7 years. Were there any pets or lifetime chargeable transfers made within that 7 years? If there was, you must revisit each of those gifts and work out what the tax is now due on that particular gift. And the way that you do that is for each of those gifts, you have to then look back 7 years from the date of the gift. So potentially, if you had a lifetime chargeable transfer made 7 years ago and a previous lifetime transfer made another 7 years, you could be looking back up to a maximum of 14 years from death to try and work out that cumulative total. But it's only any gifts that were made within those 7 years which could be chargeable, but you might have to then look back up to another 7 years to see whether or not something has already used the nil rate band available. So think of it as though the nil rate band is sort of refreshed every 7 years. So once there's been a gap of 7 years, then you get another nil rate band available. Okay, so hopefully that has dealt with the basics of inheritance tax. Now, I haven't gone into all of the complications, but if you can understand that basic level, then you should be able to at least get some of those inheritance tax questions right. Maybe not all of them, but you'll definitely have a working chance on some of them. And remember, in all of the tax questions, some of the questions are going to be easier questions, some of them are going to be harder, but if you can get some of those easy ones, each mark that you're getting is a mark that's helping you towards getting to that pass mark. So again, I hope that has helped your understanding.